Okay, so in this video clip, we continue to look at how to automate varying different types of time valuations. Very specifically, we're going to focus here on bond pricing and how we would automate setting up standard methodologies for pricing bonds. Now, performing this task manually involves quite a bit of work, quite tedious. And so normally what we would try to achieve is to automate the process, remove some of the tedium associated with repeating manual estimations, ironing out any errors, so remove by testing, remove any errors, and then where needed, we can iteratively apply a particular formula using a user-defined function. Now, if you've no background at all in bond pricing, no problem, you can take a look. Just click on the link here in the Colab, which I'll leave also underneath this YouTube clip, and you'll be able to go back and trace through some of the aspects here relating to bond pricing. I set it up in Excel, which is in some respects quite intuitive. So if you want to view some of the context here, background knowledge, all there, right? Okay, so the example we're going to start off here is a fairly simple one. We have a bond which has a coupon stream and a face value. And the coupon is a stream of money or cash flows that are basically aligned to an annuity type structure. And the face value is a alternatively referred to as a redemption value or nominal value of the bond. It's the face of the bond. For instance, if we had a face, if you're receiving at the end of 3 years on this bond $1,000, that would be the nominal value or redemption value of the bond. But you would also get typically a coupon payment, maybe 6% of face. In this instance, the annual coupon payment is 6%. So 6% of the 1,000, that gives us 60 each year for 3 years. And then at the end of the 3-year term, it's 60 coupon as well. If we apply, like before, discounting on the bond at the 5.6%, we can determine that the value of the bond is 1,010.77. Okay, so this is kind of our starting point. We want to look at the manual estimation, then look at the benefits we extract by automating, and then setting up in a user-defined function. To do the manual estimation, no problem. We can run that estimation here, and we get back our 1,010.77, no issues. Of course, with these type of estimations, if there's humans involved in the process, it's easy to leave out an operator, and then we get the wrong result. Okay, so makes sense that when we're performing these type of estimations, that we would automate. We could use a loop. Now, before we use the annuity structure, but the annuity structure could also be set up as a loop. That offers some advantages. And again, if you want to see, again, some context around that, how we would set up the formula below, take a look at this video clip. I'll just toggle through this a little bit here, but we could create a loop. So instead of an annuity, we could say, look, we set out a user-defined function that reads the stream of income, cash flows, those 60s per period for the 3 years. And then we apply the discounting in parallel to the arrival of the cash flow. We seed the value P as a catch-all. So we initiate at 0, but we put through loop, it accumulates, and we apply that discounting using the NP power operator from NumPy, and we've imported the NumPy library. And then we set out the cash flows here, the 60, 60, and the 1,060. It's for a 3-year term, so this would mean up to the 4th observations, not including. The interest rate is 5.6%. The discount is 1 over 1 plus r to the power of t. and then we sum up. So if we run that same snippet of code, setting it out as a loop, as opposed to an annuity, we get 1,010. And again, something similar here, maybe a little bit more notation, explanation, same type of loop, and we verify we're getting 1,010.77. Okay, okay, so that's just to introduce maybe loops in Python also, which could be very useful here. That could be important if, let's say, we had amounts of money here that weren't uniform. If we had just cash flows and we wanted to apply a discounting at the 5.6%, we could allow for different types of cash flow. And again, that obviously is useful. But we're going to focus here on this type of estimation. You know, what if the bond was being discounted at 6% also? So before, that would be a par bond, and we would get 1,000. And we could come back here and just verify the result here. If I change the interest rate to be 6%, does this loop produce a bond price of exactly 1,000? It does. So again, demonstrating that the formula in fact is working. But if we discount at the same rate at which we apply the coupon, and the coupon is 6%, we get a par bond, that the value of the bond is equal to its face. Okay, so that's an example of a par bond. Now we could do a manual estimation here and round it to 2 decimal places, and we get exactly the 1,000 again. Again, you know, the manual estimation runs the risk always that with human error, when you input in a manual formula and estimate, that somewhere in the process there's some human error. If we do it correctly, of course, we get the right answer, but are we guaranteed in terms of doing it correctly? And that's not always guaranteed. And so there's some benefit to automating the process. Once we have trialed and tested our formula, then we can be confident that we can deploy the formula in all kinds of different scenarios. Again, here we've put in our different cash flows. If we change this to 50, it'll be less than 1,000 exactly. Let's just try that. Should be less. It is. We put back in 60. Seems to be producing the right results. And I've left a link to the video clip. Okay, now there's other types of loops you can run in using NumPy. I leave those here for you to have a look. I'll also post the link under the video clip. And I'm going to go very specifically here at looking at what if the coupon payment was more than once a year? So what if the stream of coupons was twice a year, so 60 per year, but coming at intervals of 6 months? So then instead of 60 at the end of 1 year, we have 30 at the end of 6 months. And then if we were to adjust the interest rate to reflect the semi-annual compounding, we would divide the original 5.6 by 2. That would yield us a rate of 2.8%. And when we run through the manual estimation, we get 1,010.91. Okay, and we could automate that using a present value annuity factor. And again, for whatever reason here, I'm using before I was using R, but I denotes the rate of interest. So we have a periodic payment. We multiplied by the present value annuity factor. And then in addition to having an annuity embedded in the bond, we have a face value or lump sum or redemption value that we discount as a lump sum. And because the frequency of the compounding is twice a year, we have to incorporate M to reflect the higher frequency or periodicity. Okay, so with a manual estimation, the present value of the bond we can determine as 1,010. And using an annuity, we also get that 1,010.91. if we were to apply this formula here, can we verify that the result we obtained here is consistent with what we've determined here using the formula? So let's just run by inputting in M equal to 2 for 3 years, discounting 5.6%, the face value is 1,000, and the coupon payment is 6. And if we run that, now we haven't set up a user-defined function, but we're just verifying the formula. And we can check back, yes, 1,010.91. Now we could round to 2 decimal places, and that would round up to 91. A quick check to see that our model is working. If the rate of interest is the same as the coupon rate, then the value we obtained for the bond will be its face, and that should be 1,000. So this is just a quick check to see that our model, the formula set out, is working the way it should work, and we're getting exactly 1,000. That's great. Let's go back to the 5.6. And we could do one more test. If I change the M to 1, then we should go back to the 1,010. Now the rate, go back here. If the rate of interest 5.6 and the coupon is 6, then we get, and it's 2 years, 1,010.91, like here, 1,010.91 when rounded up. If we change the interest rate to be 6%, we get the par value. Okay, so that's working out. And if I change back the interest rate to the original, but we're not compounding semi-annually, but annually, we should get our 1,010.77, 1,010, the value that we have here, 1,010.77, this value. Okay, so let's come down and just verify that that result holds. So we're changing back M equal to 1, so 1,010.77. Okay, so our model looks as if it's relatively robust. Again, I've done that again here. And if you want to see the context, a little bit of background around this, you might take a look at this video clip. Just tap on the link, click on the link, and it'll take you through the YouTube clip for background. Now, we might want to visualize a little bit the relationship between the interest rate and bond for economic analysis and financial analysis, macro type analysis, and for accountants, people involved in the pensions industry and so on. You're very often trying to look at, determine the interest rate sensitivity of the bond. And an example, we're going to deploy here Matplotlib. So we're going to set up, automate the process using a user-defined function. And then we're going to repeat in a loop, estimating the rate of interest going from 1 to 14%, and observe the effect of changing the interest rate and the value of the bond. Now, in the standard analysis, so again, for those of you who are new to Matplotlib, this is a new library that I'm putting here. Matplotlib is the standard library for visualizing and graphing. Right, there are a few. There's Plotly, Altair, Seaborn, and all very capable libraries, providing us with really magnificent visualizations. Here we're going to use Matplotlib to do a scatter graph, but we want to re-estimate the value of the bond for a range of different interest rates, where we're setting the interest rates going from 1 to 14%. And I've automated the semi and the multi-period discounting, where we have an annuity structure built in to price the bond. So to determine the present value of the coupons and the discounted face value of the bond, and then perform iteratively an estimation of varying bond prices for different rates of interest. Okay, so we've set out the formula here as like what we have done before, but we want to generate a visualization where we observe what happens to the value of the bond as the interest rate goes up. And one thing we can note here, when the interest rate is 6%, the value of the bond is 1,000. So we know just using a preliminary check here, we must be on the right track. And we can see that as the interest rate increases, the value of the bond declines. And of course, we're using this function here to obtain our result. Now, can we check that that form is working correctly? Well, we could take the bond price and invoke that. So we can say bond price underscore price, and then open our parentheses, and then we can introduce the values, but the arguments have to observe the ordering set up in the formula that we defined, the user-defined function. So I'll put initially m is equal to, we can go with 2, and then the time period we're going to say is equal to 3 years. And we can say that the rate of interest is equal to 0.056. And then we can say that the face value is 1,000. So we're getting the face value here. So the ordering is M, 2, 3 years maturity, interest rate 5.6, face value 1,000, and the coupon rate is 6%. Run that, we should get our 1,010.91. And if we change it back to 1, 1,010.77 for the price of the bond. Okay, so that's useful. Also note, we're triggering the estimation of the bond here and creating a graph by creating this loop where we're saying the X goes from 1 to 14% in 14 steps. So let's take a look at X. What's X here? X is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 14. Right? So we could put to, in theory, we could come back here and do something a little bit more exciting. Maybe we could go up to 20%, 20 steps. Run it again. Now you can see we're going further up. And if I want to see X, 1 up to 20%. Okay, now if we wanted to create a more observed effect, okay, so that's for a 3-year term. What if we wanted to observe for 5 years? So change the maturities for 5, 10, 20, and 30 years. So use the same code again, basically. We're defining the same user-defined function to obtain the value of the bond, where the frequency can be high frequency bond. And then the maturity on the bond can be 5 years, 10 years, 20, and 30. And then we're going from 1% to 14% in 14 steps. And then deploy the Matplotlib library. If we run that estimation, we have the 5-year maturity, which looks like this, the 10-year maturity, the 20-year maturity, and the 30-year maturity. And we can see in each instance, as the interest rate goes up, the value of the bond declines. Okay, how many estimations have we performed? Well, we have 14 by 4, right? So we have 14 maturities, and we have 14 different interest rates. So we have 56 bond price estimations. Again, what really we're demonstrating here is once we have a user-defined function, we can automate the process and we can scale. And then with the visualization tools available in Python, we can observe directly the outputs. And we can glean from our visualizations maybe some relationships that are quite key in the area of fixed income, in the area of pensions, in the area of understanding nuances within the finance area. One area that one of the key areas that is very often addressed in the fixed income space is how sensitive is your bond portfolio to changes in interest rates. So if you're a pension fund and the bulk of your assets under management have these longer dated maturities, you are much more, your portfolio is much more sensitive to changes in interest rates. So if the interest rate goes up, if you're a pension fund and you have a lot of longer dated instruments in your bond portfolio and the interest rate goes up, you can see here a very dramatic drop in the valuation of your portfolio. Whereas for lower dated instruments, smaller, more significant. I mean, we could go back here and apply a what if scenario and say, okay, let's take a 1-year maturity instrument and then have the 14 different rates of interest and re-estimate. And we'll notice here that there's a fairly significant flattening out of it's almost a line, no longer a curve. And changing the interest rate is having hardly any effect at all. And if we put the maturity back to 6 months on the lower dated bond, right, and run the same estimations again, you can see that for the longer dated instruments, always very sensitive to changes in interest rates, particularly when the interest rates are already low. But for the shorter maturity instruments, a change in the interest rate exerts hardly any effect whatsoever. Okay, so fixed income analysts pay a lot of attention to this type of math and produce measures, often referred to as duration measures, or DVO01 measures, tracing how sensitive their portfolio is to changes in the policy rate. So for instance, if the Fed funds rate, which is the policy rate in the US, goes up or down, you're trying to predict what's happening to the value of your asset portfolio. If you're in a bank, something similar. If your portfolio, if your assets are mainly made up of longer dated mortgages, you have a similar phenomenon that as the interest rate goes up, the value of those mortgages drop. But if you're funding shorter term, those liabilities, if you're funding, the liabilities don't drop, but your assets drop. And so in the area of managing a bank, asset liability management is really key to understanding some of the dynamics. And the recent demise of Silicon Bank in the US, Silicon Valley Bank in the US, actually comes down to a little bit of short-sighted planning around managing the relationship between the assets and liabilities in terms of the duration matching, funding short-term, lending out longer-term, creates vulnerabilities in the balance sheet. And again, using this automation type process, marrying in with visualization, one can see the benefits that we extract from automating the process. And so strong argument here that, you know, for those interested in those areas related to robotic process automation, it would be worthwhile if you're a fixed income analyst to coding up in Python or similar tools, similar programming languages, programming or writing up a formula that allows you to automate the estimation. So you can make these type of predictions at speed and at scale. Okay, now another area of interest to everybody, to many people, would be mortgage repayments. I'm going to look here at how you would set up a mortgage repayment schedule. And so the starting point here would be to consider just a standard repayment. So figuring out what's the repayment on a mortgage, just using some fairly elementary numbers. So for instance, we have a borrower and they take out a mortgage of 120,000 euros, a very small mortgage in Dublin. Today, hardly conceivable somebody could purchase property for 120,000. So, but we're going with it because it's a nice round number, and they're going to use it, repay back over a term of 30 years. And as always, or as is quite common, we're going to have a monthly repayment, and the rate of interest is 5 or 6, which is probably not too far off current rates, in fact. Okay, so now if you've no background here, I set this up more, go to a lot more effort explaining the small detail, in particular, the mortgage repayment schedule over the 30-year term, right? So again, if this is something completely new, click on the link here and I give you the context for mortgage repayment schedules and how we'd populate a spreadsheet with a mortgage repayment schedule for principal only and interest only. So to set this up as an estimation using present value annuity type structure, if we were looking at 120,000 was the value you had to, the sum of money you had to borrow, and the interest rate was 5%, and the repayments is monthly, and it was over a 30-year term, then the way we would estimate the payment here is we would manipulate our expression here. So payment, the monthly payment will be put to one side, and you'll notice that when we bring the square brackets to the other side, it's put underneath the line. So it's dividing. So if you like, how we estimate here is it's that 120 divided by what's in the square brackets, which is the present value annuity formula, which we've used previously. Okay, now to go through this a little bit, we could do it not manually, but we could set out the formula here and just verify that the monthly repayment, in fact, is 644 a month. Using the numbers presented, I can verify that the monthly repayment is 644 a month. Now, interestingly, if you wanted to stress test this a lot more and go to the Excel where I've developed all this, the background, and maybe the more slower approach to introducing this area, you'll find here in the video clip, right? But assuming that we're happy with this estimation of 641.19, that it's robust and we're satisfied that it works, we may also be interested in inferring what is the payment schedule over the 30-year period. So in theory, it's going to be 644 per month is what you repay. But then, like any mortgage, you're amortizing, and some component of your payment is interest and some component is principal. And if we want to set this out as a function, now we've developed it as the formula, but if we wanted to develop the user-defined function and then set out the schedule, and again, the context probably is important in the video clip. See how that's done manually first. A bit involved, but it gives you the context. And then come down here and verify if we run this function using the values that we've put in here, that the repayment schedule, and just explain the repayment schedule. So it's a 30-year mortgage. That means 30 by 12. So 30 years, 12 months in a year, that's 360 payments are going to be made in this mortgage. And the payment per month is fixed at the 644. So every month you will pay a fixed amount. We're assuming the interest rate never changes, which would be common in the US. Most mortgages in the US are fixed. In Europe, a little bit different. In Ireland, most mortgages, in fact, are variable. But let's assume the interest rate is fixed over the term. Then the breakdown of the mortgage payment into interest part and the principal part, when we sum these two, we get that 644. And so we started off with a mortgage of 120,000. We removed this amount of principal. So going into the second month, we initiate the second month where the principal has been brought down a bit, but not by a huge amount, only $144 or 144 euros. And the bulk of the payment of the first mortgage payment actually is going to cover interest. But bit by bit over the months, that piece, the interest piece is falling and the principal part of the mortgage payment is increasing. And we keep amortizing our mortgage until we get to month 360 or year 30, where the principal goes down to 0 and the last mortgage payment is basically its principal, right? And we should be left with nothing here on this principal remaining. Again, a very nice feature here with by automating the process is we can get a visual. So combining the automation capability and mounting a user-defined function and then graphing, we're able to get a bird's eye view of the interest only, which is declining, the principal. Add both of these together, we get 644. But over the 360 months that passes, we initially start where most of what we're paying, in fact, is interest, and principal is only a small component of the overall payment. When we get out to close to month 200 here, the principal part starts to exceed the interest part, and eventually the interest part declines. It falls off, and the principal part makes up the lion's share. Now, interestingly, in the area of fixed income analysis, we've seen products created where when a mortgage is created, it goes into a book of mortgages that get it sold off to investors. And some investors then so we bifurcate the mortgage book that's sold on to investors, and some investors are sold a product where they get the interest bit only, and other investors get the principal amount only. And what that allows is, if we have the interest amount, that attracts investors who want to be paid more money earlier and a small tapering amount at the end. And with the principal amount only, investors who would invest in this type of product would be getting a small amount of principal at the beginning, but the payment that they're receiving on their instrument, on their investment, increases over time until we get to year 30, then it stops. So again, by automating the mortgage schedule, we could easily explore the effect of changing our parameter inputs. So for instance, we could take our formula as given here, just Control C, and then come to the following cell. And if we were trying to market, let's say, to investors, different types of product, we could examine the effect of increasing interest rates or lowering interest rates. So let's Control V, and we'll say the principal amount, we'll go with our 120, 120, 123. The annual rate we said was equal to 5%, in fact, 5%. And the loan duration in years, we're going to say is 30 years. So let's run that, see what comes. And we get our graph. Now, if we want to observe the effect of increasing the interest rate, let's say we'll put the interest rate to a very high amount of interest. we could explore the dynamics here. And you can see that this period when we have the crossover between the principal amount and the interest amount, when the principal amount exceeds the interest amount, gets delayed. We're up here at month 300. If we lower the interest rate, if I lower the interest rate, let's say bring it back to 1%, you can see that, in fact, even from an early stage, most of the amount you're paying is actually in principal, right? And so people who got a tracker mortgage a few years ago where the interest rate was linked to the ECB rate and ECB rate was pushed down to close to 1%, they did quite well in terms of the overall affordability of the mortgage. So for instance, if we wanted to go back and just look at the schedule, amortization schedule. So the second one here, if I just want to do the schedule, Control C, and come down here. So amortization schedule. So I'm reframing now what the schedule does. I want the schedule mapped out. Okay, so if I come back here and run this one and put in the same values as I had before, Control V, and go 120, 120, 123, put in an interest rate of that 5% for the 30 years. This is what we started off with, for a loan duration of 30 years. So 30, and run our analysis. You can see that the mortgage amount has dropped. It would drop as we lower the rate of interest. So if I change the interest rate now to 1, the interest payment, the mortgage repayment drops to 385. So it's quite a significant effect by changing the interest rate on the repayment of the mortgage and setting out the schedule. The costs really come down, and the speed at which you eat up the principal also drops off as well more quickly. Okay, now when we automate, set up user-defined functions, a lot of this then becomes very second nature. We can manipulate our arguments so that we can craft very quickly a discussion to clients, or if we're advising peers in a business, if we're looking at acquiring a property and we have to advise colleagues on the different alternatives and changing the schedule from 30 years to 20 years, and what's the advantage, what's the effect in terms of bringing down the principal costs and so on. That discussion can easily be enhanced by using this automation available in Python. Okay, now we could also use one of the nice features that I haven't really spoken about that much, but Colab is a powerful tool because exactly the same exercise we've performed here using Python, we could set it up as a C++. And we mentioned previously when we looked at the TAOB index that C++ is still quite a significant language, especially in the area of app development. And we can write C++ code. I took this snippet of code from Andy Duncan here. You can follow the link. And if we preface the cell with percentage write file main CPP, when we execute that and go into the content folder, we will see in the content folder that main CPP file is here. And then to execute it, we say percentage script, and we invoke the main file. And that also will produce in a relatively timely fashion the same type of mortgage amortization schedule. Now, I've done something similar using R. R also will work in Colab. There's a few different steps here for implementing R, but R is another language. And in terms of automation, there's a lot of code out there that maybe you want to make use of. And I explained the steps here, how you can run R in Colab. And the same, creating the amortization schedule. And also how you can link R to Excel using the BERT add-in. Okay, so I've made available a very similar type of analysis using R code, but we're really interested here in Python. But just to point out how versatile Colab is, we can run C++ code, we can run R code. The native language, I guess, is Python. And we can also do that type of graphing in R. And if you want to link R code into your read the R program automated file and run the algorithm from R into Excel directly, I've left here some explanation in terms of how that can be accomplished. And just click on the link and it'll bring you through. Okay, so let's leave that there then.